Hello, everybody. My name is Andrew Dix, and I'm the founder of the Crowded Media Group. We are the publishers of Crowdfund Insider. And today we're going to be discussing Reg A Plus, or Regulation A. I have two experts here that have been engaged with this business for many years now, so we're very fortunate to have them here. First of all, I'd like to thank our sponsors, which include Dealmaker, as well as Dalmore Group. And so I'm going to ask my two panelists to introduce themselves, and we're going to start with the Dalmore Group founder and chairman, Eitan Butler. So, hello, Eitan. Thank you for showing up.
Thanks. Yeah, Andrew, thanks, and great to see you again. Sally, amazing to see you too here. I am Eitan Butler, the founding chairman at Dalmore Group. We are a FINRA and SEC registered broker-dealer and investment bank. And over the last number of years, we've quickly become a pretty comprehensive technology platform for capital raise activity in the U.S. and internationally.
Awesome. Thank you, Eitan. Yeah. Sally, you're an OG. Let's hear what you're doing today.
I don't know about that, but yeah, I'm Sally Outlaw. I like to say, don't let the last name scare you. I'm really a good person. An outlaw in finance is occasionally questionable. But no, I've been in crowdfunding, about 13 years. I started in reward-based crowdfunding, the sort of Kickstarter model. And then when the Jobs Act rolled out in 2015, which opened up, really, they updated securities laws and allowed people to invest in the crowd-funded projects and companies. So I then gravitated into investment crowdfunding, and that's what we're doing now. That led me really to found my company, Worthy Bonds. So, been at this for quite a while, as you said, Andrew, and Reg A is my favorite thing in the world. I always say, don't get locked in an elevator with me, because I'll have you converted by the time, you go from your floor to the ground floor. But love it, and I'm happy to talk about it today.
Yeah, that's awesome. I'm really happy to have you here, Sally, because you are really an OG. You predate, my participation in the sector of online capital formation. So we're really fortunate to have you here, because I know you have seen a lot and you've done a lot, and the runway going forward is pretty awesome for you. So today we're going to talk about Reg A Plus, or Regulation A. As Sally mentioned, it was created under the Jobs Act of 2012. It was one of three different titles in the act that facilitated online capital formation: Reg CF, which you can raise up to $5 million, Reg D 506C, which allowed an issuer to promote the offering online, and then Reg A Plus. And I would say that Reg A Plus initially was the exemption that inspired the most excitement for people in the sector. Initially, issuers were allowed to raise up to $50 million online. That has since been increased to $75 million, but many people described it as a mini IPO type offering because it's an exemption that requires an offering to be qualified by the SEC, which is kind of interesting, which leads to some very big positives, in my opinion, for the exemption. So both of you have profound experience under Reg A. Eitan, under leading Dalmore, you guys have raised over $1 billion, I think, in Reg A alone. You have 3.6 billion in offerings live under Reg A Plus. Again, correct me if I'm wrong, and 4 billion in the pipeline. And I would say that initially the exemption took some time to gain some traction, but I think we're seeing more traction today, which I think is very exciting for people in need of capital. So I wanted to start out the discussion with asking each of you, what are the qualities of Reg A Plus that makes it interesting for issuers, firms interested in raising capital, that need access to growth capital? I'm going to ask you both to answer this, but I'll start with you, Eitan.
Yeah, look, 75 million from pretty much anyone over the age of 18, pretty much in the world. And you could set the minimum investment to whatever you want. It could be $1 a share. And the shares that you sell are freely tradable. right? Doesn't mean there's liquidity. It means that there's no lockup period. That's pretty powerful. That combination. So to those who are able to successfully get enough people to a landing page and get them to convert and trust and make an investment, or join a community and do that same thing over time, the Reg A exemption is very powerful. And we're seeing a lot of expansion in the space naturally amongst the fractionalized components of the assets that are being fractionalized and sold through Regulation A, in a similar way that the kind of the Web3 blockchain crypto world was operating with this idea of issuing, fractionalizing, and facilitating secondary trading, right? That immediacy of it all, where everyone can participate. Reg A, I believe, allows for issuers to do it legally, but to get as close to that cycle of identify, fractionalize, issue, and facilitate trading, right? So I think those are some of the reasons why we're seeing a lot of growth in that space.
Yeah, and I think it's interesting that you mentioned crypto specifically, because there's been a lot of people in the digital asset sector that have said, hey, Reg A plus, that's the path for us to do an offering that will make it legally compliant, which, as we all know, ICOs were not very legally compliant, and we're all working towards a path of having something that will be approved by regulators. So, Sally, from your point of view, what can you add to what Eitan just said about Reg A plus? Why is it a good vehicle for issuers?
I think certainly I agree with everything he said. But as a founder who's raised money, right? I've raised money from angels, I've raised money from VCs. The fact that you can be in the driver's seat as a founder, you don't have to wait on, you don't have to network and work through, how to find the investors who are in your sector, or network to try to find an intro to the VC, and then are they in your sector? Are you meeting their metrics and their criteria? So for me, it's like I've got a great story, I've got a great product, maybe I have a bunch of customers. I can go out there and raise from not just your friends and family, but your customers and the public. So to me, it just opens up those channels of capital, but also to Eitan's point. You can do the security itself is flexible. You could do debt like we do. Our current product is a $10 bond. It's a debt product. I've used other types of crowdfunding for equity raises. You could do rev share. So it gives you also a little more flexibility as an entrepreneur, not just on your cap table of who's going to support you, and you have access to them, but in the structure of the security. So like I said, you could use it for debt, equity, or some other in between, like a rev share product or like rev share approach. So I like it from that perspective. And I think also you have the marketing benefits that if you have, friends and family in the public and customers who are investing, they're going to go out and promote your business. Hey, I own a piece of that bakery, or I own a piece of this company. So it sort of is the word of mouth marketing as well, that you get that benefit. It's not just a silent investor like a VC or, an angel might be, but now you have dedicated, security holders in your company that are out there, visiting your business, supporting your business, and promoting your business because they're an investor as well. So I think there's marketing benefits along with the other things we're talking about, the flexibility of the security and access to the capital. If you don't know, angels, and you don't know VCs, tell your story to the public.
Yeah, and so
one more thing I wanted to just
go ahead, Eitan.
One more thing I wanted to just point out to add to that is that, Reg A is oftentimes associated with crowdfunding, right? Like some of the other exemptions. And the reason why it makes sense, because now you could crowdfund, right? Now you could go and raise money from the crowd. But it doesn't necessarily have to be associated as much with like the startup component of a business, because it is an exemption that, yes, it allows you to raise X amount of dollars for one specific deal, for sure. But what we're seeing, and perhaps what's even more interesting, is it's an exemption that allows for you to raise up to $75 million per year. So issuers are, like Sally, are approaching it not just, I have a great deal that I want to be able to go and market and promote. It's, I want to build a community, and I want to understand what their needs are, and I want to craft product that they need and that they have an appetite for, learn from them, deliver year after year, and expand my platform. So it's, Dalmore powers platforms like Sally's platform and others in that way, where, that's really where we see the trend. Issuers are becoming repeat issuers. They may do a CF and a D and an A, or they may do a fractional A and then raise money for themselves through a CF. That's what we're seeing. It's really, the business is growing in that way over the last few years.
Yeah, it could basically be a constant source of capital, to his point. We've done 4 Reg A offerings. The first 3 we sold out, each 50 million. Now we're in a 4th 75 million. We just opened a 5th 75 million. So it gives you this sort of evergreen capital, as long as you have a place to put it, right? If you're, right now we're doing real estate, so it allows us to do more affordable housing or more community real estate projects. So you can think of it that way. Yes, you can use it once to raise equity for your company or some other, more sort of short-term need. But I really like it, to Eitan's point, I really like it as a source of sort of evergreen capital where you can continue to grow your business and have more and more impact in the community.
So under Reg A Plus, currently there are 2 tiers. There's tier 1 and tier 2. With the higher tier, you can raise 70 million, 75 million. The first tier, I believe, is 20 million. Eitan, are you only doing the 75 million tier?
Look, tier 1's not very user friendly because, especially for those, you don't need to get audited financials, but you really run into challenges, with the issuer having a need to register, in each specific state that they want to conduct the offering. And that ends up being challenging, to say the least, expensive, unpredictable, and oftentimes unsuccessful, which is why many use a broker-dealer, which can be helpful in certain ways. But we advise issuers who are looking to raise even under $20 million, let's say 5 million or 10 million or 15 million through a Reg A, to go through the tier 2 process, because it allows you to raise money in all 50 states, right? As long as the broker dealer that's involved is also registered in those states. Whereas tier 1, if you have all your investors in New York and you have a quick, a $5 million offering and you're an OTC company, that's where you'll see, tier 1s. Right, it's where there's specific investors in place. They're looking to, produce freely tradable securities, increase their shareholders. They may add a warrant, whatever it might be, to the price. So we're seeing more OTC companies utilizing tier 1.
So one of the big things when Reg A Plus came to be was state blue sky review exemption. Can you explain that for our audience, Eitan?
There's different components of blue sky exemption, but basically there are federal securities laws and then there's state-specific laws. And you before you go into a securities offering, even though it seems to be a federal exemption in certain cases from your perspective, you really need to have proper securities counsel that could advise you, according to the exemption, what state requirements you have pre, during, and post for the activities that you're involved in, right? So a lot to advise on, and there's people that could explain it from my compliance team and legal side better than I can. But I know that it is something that you need to be very careful about. Well, and oftentimes experienced counsel will navigate.
I'll say this, the states hated it. They hated Reg A Plus when it was first approved under the Jobs Act. They actually sued the SEC because they wanted to maintain blue sky review, which created a cost structure that was unfeasible. Because actually Reg A Plus was a new iteration of old Reg A, an exemption that nobody ever utilized anywhere because it was too cumbersome. And it was fixed because Congress told the SEC to fix it. And so that was a huge thing, and it continues to be a huge thing for the exemption. I'd also like to point out that the offering documents. So mini IPO, you have to provide an offering circular. It has to go through the SEC review. It has to be qualified, which is interesting. I think from an investor perspective, that provides a good thing. And you can disagree with me with that because you have to put everything in there. And so for an investor, there's a lot of transparency. And I want to talk more about the investor things, but I forgot to mention testing the waters. And I don't know, Sally, if you've done that, or Eitan, if you work on that a lot, but it's also a characteristic of the exemption where an issuer can test the waters to see if there's sufficient interest to actually pursue an offering. Do either of you have an opinion on that?
I can jump in. Yeah, I've never used it. We've never used it at Worthy. I don't believe originally, could you always test the waters? I think one of those was added. Maybe that was Reg CF, but yeah, we didn't do that. Yeah, we didn't do that in part because we did worry, and I do see this drop off. If you test the waters, you can get a lot of interest, but then by the time you then go ahead and file and go through the review process, it's sometimes hard to get those people back. So to me, if you're going to market, now Eitan may have a very different opinion because he's done over 200 individual Reg As. I've just done 6 of my own. But we were a little concerned to spend those dollars marketing and getting people excited, and then you find out it could be 9 months, before you get something approved, qualified by the SEC. And then I think it's hard to then go back and get those people re-excited and sometimes to close them. But that's just me from a founder marketing perspective. But I'm sure Eitan has more wisdom on this, more history.
Yeah, we've been putting together the data flows and monitoring the effectiveness of different test the water campaigns, and it's producing some and trying to make them better. So there's a compliant way to let people know that you have something coming. You can't tell them the specifics, whatever it might be, but you basically say, if I end up doing this, would you have an interest in learning more about the opportunity? And if so, kind of maybe how much, and should I contact you if so? So it's basically like a tap on the shoulder. I would agree that you don't want to necessarily spend a big marketing budget going out because you can't rely fully on the data you get. There's going to be a much bigger drop off. They used to use the example of you meet someone at a bar and you say, yeah, I'm ready. And then it's like, yeah, I'll come back in a month. It's one of those type things where, but that's the logic around saving the budget for the actual raise. Look at what other people have done to prove they've proven the model. There's people out there that exist. Save it for that. Now, the flip side is if you have an existing base of users, customers, subscribers, there's nothing wrong with, letting them know, hey, you guys are family. We're doing this. We're planning this. We're thinking about doing this. Would you have interest in this? There's no downside. There's no cost really. I think in doing that, and perhaps you could go a little bit wider. But again, save the real ad spend for when it's live.
And by the way, there are rules around testing the water, so you can't just as Eitan mentioned, there's only things you can and can't say. You have to have disclosures if it's on a website that you're not taking money. I mean, so I don't want to lead people to the idea they can just start calling their friends and family and post on Facebook, hey, we're going to be doing this. There are compliance, issues around the Testing the Waters campaign as well. So you'd have to research that. Yeah.
There's one other quality to Reg A Plus that I want to touch on quickly before we move on, and that's secondary trading. Now, Sally, I know you're not doing that right now, but Eitan, you power a lot of issuers that do go down that path, and it's unique in the private securities space that once you issue a security, you can actually, if you want to, as an issuer, you can make it tradable, correct? Yeah,
you can. And you generally would do so through a alternative trading system. There's multiple ways to do it. Our clients have completed over 200,000 Reg A secondary trades in the last, I think, 2 years. And that's growing. The private, like we talked about this in the past, but the private markets are a lot bigger than the public markets.
Yes.
The key is to get the private markets to behave a bit more like the public markets so that people are more comfortable allocating to private market opportunities, including RIAs and the managed capital. And that's where a lot of the gatekeepers are, right? So you have to make it easy for them. And if you show up with market making and sufficient asset size and typical private market yield opportunities, that's a different game than if you come to them with, a startup opportunity where you want exposure in that way. So, again, that's a direction I really see things going in.
Yeah, I actually agree with you, Eitan. I think that over time, the liquidity hurdle, the tradability, I think the technology and the experience is going to figure it out. And I think that'll be huge.
Because otherwise, how am I going to get out?
Right.
Otherwise, how am I going to get out? It's one thing if I look at this, like I'm building a portfolio of startups, lottery tickets, not lottery tickets, but the majority of companies are going to fail. That's historically what has happened. So, but the idea is if you could catch one like a VC that does a spectacular return, or a few that do decently, it could be worth your expense, your effort. The challenge, though, in building a portfolio of private securities is that oftentimes it's not clear if and when you'll ever be able to exit, right? And so, the idea of having, an active secondary, ideally with some activity and some support, kind of, could really change the dynamics a lot. And I think that's going to be what's going to help bridge the gap from private market production with building your own community versus, okay, let's get some RIAs to allocate to some of these strategies that are built for what they're looking for.
Absolutely, I agree.
It's a matter of education. I mean, I think that Worthy, that's something we're going to really focus on over the next year. Is more it's sort of literacy around alternative investments in this whole Reg A world. If we can educate people about the secondary market, you can go in there and trade just like the public markets. I think there'll be more activity. I don't think people even. I mean, a lot of people don't know about Reg A, so they don't understand private versus public markets, even on a basic level. So I think if we can continue to talk about and get the word out and educate, hopefully we can drive more traffic to secondary platforms.
Yes, absolutely. So the qualities of a Reg A plus offering, or as an exemption, that are good for investors. Now, I already mentioned the disclosure, the fact that you have to have an offering document approved by the SEC or qualified. I think that provides a heightened degree of transparency. You can read all the risks, you can read the performance, you can read any conflicts. And I advise people to actually who are considering to invest in Reg A plus securities to do so. But what are some other characteristics that make the exemption interesting for individual investors?
If I can speak to that, I mean, I'm mission driven, so I think where you put your money matters, and this is a place you can make a difference. If you can invest in young growing companies in your community, you're getting that mission play, but you may also get the nice return. To Eitan's point, you might hit that, that unicorn. Imagine a world where 50% of your investments are made within 50 miles of your home. If we can start shifting that money into our communities, into main streets, into these small businesses, these towns and cities are going to be more vibrant. There's going to be more, success with entrepreneurs. So I on the mission side, I think it's super important that people, learn about this and get involved. Leave it on the return side. I mean, what really motivated me, I get so mad when you think about what's broken right now is private companies wait so long to go public. They're worth billions by the time they hit the public markets, and all that value has accumulated in the pockets of a handful of VCs, not my 401k, not me personally as a retail investor. So, this sort of changes that model. Instead of having to wait for these companies to grow to billions of dollars in value before they hit the public markets, maybe have this much of a return for retail investors. This allows you to get in early in the private markets, and you as an individual get to take that ride, hopefully, to a high valuation. So, just from a social mission and return perspective, I think it's a great opportunity for investors.
Yeah, I think you're spot on, because the data indicates that in the past 40 years, it used to be that, participating in an IPO in a public market could give anybody access to an early stage venture that had potential for growth. And again, not all of them are successful, but some of them are. Today, the VCs and the big money have learned to jump ahead of the queue and gain access to these opportunities first. At the same time, the people that operate inside the beltway, the policymakers and regulators, have taken a rule upon regulation approach to such an extreme that the cost is so high to be a public company. So that potential return for a smaller investor has gotten smaller and smaller and smaller. So yes, absolutely, I agree with that. That's a spot on statement. I also think that Reg A Plus, in providing access to private securities, provides access to new and different asset classes that you historically have not been able to access. And I'm going to ask you about this, Eitan, because I've actually seen several issuers use your services that are really unique and interesting. Can you expand on that? Yeah,
it's interesting because they're connected, right? We're at a time where it's not only the discussion isn't only what's beneficial about Reg A securities to investors. It's also met with a time where these exemptions come with the other side of it, which is opening up opportunities for more entrepreneurs to conduct their offerings, and that's met with, who in the past weren't, it was very challenging, met with everyone now has a relatively equal opportunity to participate in a Reg A offering, right? So it's like it's both sides of it, which is totally healthy. Yes, there's going to be more companies that don't succeed, right? Yes, there's going to be more investors that are approaching this for the first time that aren't savvy, haven't done this before, and so the responsibility, diligence, and regulation obviously has to be at the core of all of this, as far as what you could say, what needs to be checked, making sure there's no bad actors doing this. But a natural benefit of Reg A is that, like I said, you have, from an investor's perspective, you should read all of that. I mean, all the risks, like literally read the risks, look at the backgrounds, audited financials, relatively light, but ongoing reporting requirements. These are things that you have a right, that the issuer has a responsibility to provide to you. And I think that gives more transparency to the average investor who's considering making a $500 investment in a deal. And it kind of sets a threshold. Doesn't mean that they're going to succeed. It just means that they have securities counsel. They went through the process of submission. They took 4, 5, 6, 7 months and back and forth. They had a budget. They got an audit. To me, that says something about the level of how prepared an issuer is and what they're willing to go through to bring an opportunity to the market. Whereas a Reg D is something that you could really take to market very, very quickly, and much fewer people could participate in it. So, again, I think that the secondary side is ultimately what's going to be really the most exciting here when it's fully put together. Just the ability to issue and facilitate secondary allows for endless opportunities, on the fractionalization space.
Yeah, you could build a basket of a little of everything. You could take our debt product and someone else's equity product and a piece of, a different asset class, a collectible or a racehorse or whatever it is. You could really have a diversified portfolio, which, I love that part of Reg A.
Yeah, it's me too.
Yeah, I think we're really at the tip of the iceberg. I think that people like you all are just kind of starting and figuring this out, and you're going to be creative and innovative, and you're going to leverage technology to do things that were previously not possible in the past. And you're going to be able to offer this to all investors, not just wealthy VCs, not just accredited investors, but smaller investors too. And I think that's very powerful going forward. So I want to jump back to you, Sally, very quickly. Again, you're an OG. You've been doing this for a long, long time. And so you probably have the scars to prove it. But I wanted to mention that. Yeah, but I wanted to mention that at one point in time you did a Reg CF, and then you moved on to Reg A plus. Do you want to share anything about that specifically? I just think it just kind of adds some perspective here in our discussion.
Yeah, I mean, as I mentioned, I started in reward-based crowdfunding, so I've come full circle, right? I did a lot of speaking for Entrepreneur Magazine at their events, and I used to talk about, you can raise money without ever going to the public markets. You can start with, your own capital, right? And you're sort of testing the market with your minimal viable product. And then you can do a Reg CF and get a little bit, money there to grow. And then from there you could do, a Reg A, and you can just sort of keep this money in the private ecosystem. And we did that. So we started Worthy with, our own investment. I didn't want to go raise from outside investors until we had, sort of testing the market. We had our minimal viable product, and we had some early takers. Then we went out to, at that point, raise from some angels. And what happens with angels is they have their own schedule, right? Oh, I'm going for the summer, or hit me up when I come back, or yeah, we're interested, but we're not having our meeting until next quarter. So we had a lot of interest in our initial round. This was like 2018, right, when we started. But I needed bridge capital to get me to close as angels. I knew it was going to be, a 6-month process because of their different schedules. So I went to the crowd. That was my DNA. It's always been in my DNA. I've been doing this for over a dozen years. And we did just a $250,000 round in order to sort of bridge us from, our own capital to closing on those angels. And then we did have one VC later. And that's the only equity raise we've done. It's really, we haven't done a big Reg A equity. We actually are going to be doing a Reg A, we hope, equity raise, in the future, because right now we just use it for debt. But we did a $250,000 Reg CF. It was, we actually exceeded our goal. What I loved about it was the crowd really saved us. I mean, they saved our company. If we didn't go to the crowd and get that bridge capital, I'm not sure we would have made it to close, those angels. So, that capital let us continue to grow, let us continue to advertise, our product and get, even more sales, so that it was easier story for the investors to, the angels to get behind us, because we increased our sales in that time period. So I'll forever be grateful for the crowd, but it works. I mean, I wrote a book on it, Cash from the Crowd, for Entrepreneur Magazine years ago. I mean, I love community capital. I think everyone should be stakeholders in their communities. We should be supporting, our local businesses. And they came through, right? They came through and helped us, in that time period. So it was very successful for us. And we got, obviously, people also came and bought our bonds, right? They bought equity in the company, but then also would buy our bonds because, again, to my earlier comment, your customers, who are investors become, people who support your business and almost help you market. So yeah, it worked.
Yeah, I think you should consider running for Congress, because we need more advocacy like that.
I love regulation.
Community capital.
Yeah. Well, I mean, what makes me upset is, I'll watch, I'll be on Instagram and I'll read people complaining about how things are broken, financial markets are broken, and they're getting taken advantage of, and, they can't build wealth. And I'm like, there's the power here behind crowdfunding. Get involved. You guys have, the power of the crowd. If 1 million people said, I'm going to dedicate $500 a year, that's $500 million that could go into our ecosystem to help young companies. So I never shut up about it. I'm, as you can tell, I'm just a huge advocate in the power of the crowd and what we can do with that capital. For sure.
So Worthy, you started with Worthy Community Bonds and Worthy Pure Capital. Correct me if I'm wrong. And then now today you're doing Worthy Property Bonds. Can you explain to me? And these are all Reg A plus offerings. Can you explain what the Worthy Community Bonds were? Explain your first products. I'm curious as to what these actually were.
Yeah. So our first 3 offerings were focused on business bonds. There's an exempt. So what we haven't mentioned is, in order to use Reg A, you have to be exempt from the Investment Company Act. If you're not exempt from the Investment Company Act, you cannot use Reg A. And if you think about being an investment company, it's like a mutual fund, right? If you're taking money from the public, you're pooling it together, which is what you do in Reg A. And then if you're invested into something that's considered a security, then you're an investment company. Mutual funds do that. They collect money from the public and then they invest it in, multiple, stocks. So if you are that kind of company, you cannot use Reg A. So we look like that, right? Because we're selling securities, we're aggregating that capital, and then we're lending that money out. And believe it or not, most loans are considered a security. Doesn't make sense on some level, but that's the way the SEC sees it. So there's only a few exemptions in lending where it's not considered a security, and that is certain kinds of business lending and real estate is another big category. And there's a few other categories. So the business lending we did, it can't be general purpose loans. You can't lend money to a business to pave their parking lot or make a website or something. It has to only be tied to the sale or purchase of merchandise in order to be exempt from the Investment Company Act. So that's what was our focus. The first 3 funds were on purchase order financing, receivables, inventory, supply chain, basically a limited type of lending that you can do under Reg A. So we sold out those 3 $50 million offerings, and we did that for a number of years. And then we diversified now into property. I'm a real estate broker. I have my real estate license. I'm not active, but I've been in that industry a long time. I'm the daughter of an architect, and always been interested, obviously, in real estate because of that. But also, I'm very big on affordable housing. It gets under my skin that people don't have homes to live in and how unaffordable it is. So we've done some affordable housing lending as well. So that's where I sort of wanted to shift things. We did, multiple years and multiple offerings of business bonds, and now we're really focused on the property bonds and trying to use that money. Hopefully, we'll find some good impact investments, in affordable housing and other things. So it's also nice because our Worthy community members can have a diversified portfolio, right? Some of their bonds are business, some of them are real estate. We may find some other things to other offerings. We are going to real estate. The nice thing is you're able to also order design an equity product. So we'll be doing that next. We're designing a security with a higher return. Our current bonds are APY 5.73. We're edging towards 6. But if you did an equity real estate product, you have the opportunity to sort of participate in the upside if that building is sold or what have you. So, we're hoping to come out, in the next 12 months with another product that'll have a higher return, different parameters. Maybe you have to hold it. Our bonds now are liquid, but these would have to be held. But anyway, point is, real estate offers a little more flexibility on the kinds of securities that you can design and offer and the kinds of returns you can provide your community. So that's what we're focused on.
So for the property bonds, are these secured? Is it secured debt or are the loans secured?
Correct.
Okay.
So and what's nice about our bonds is, there are a few other real estate offerings out there, but what I like about ours is you don't have to go pick an individual loan. All your money's not in one loan. If that goes bad, we've never had a loss in our real estate loans, by the way. But essentially, it's a whole portfolio. So when you buy a Worthy property bond, it's backed by our entire portfolio of real estate. First mortgages essentially. So
how are you sourcing these properties?
Well, we work with a handful of originators. We don't want a big overhead of, we re-underwrite, the people that we're working with. We have originators to underwrite the deals and they bring them to us and then we re-underwrite them with our own criteria. But we basically work with 2 or 3 primary originators. But, we're always looking. I've had some other talks. Like I said, I really would like to, go more into affordable housing and things like that. So I've reached out to a few other real estate developers to see, if we could work together. But we don't service and originate them. So, that piece is handled by somebody else. We just re-underwrite it. But yeah, our LTV is 55% to 65%, occasionally 70%, but we stay in a pretty secure loan to value ratio so that the bonds are backed by that whole portfolio of that LTV loans.
And you've never had a default, right?
Not in real estate. Yeah, real estate's been good to us. We're gonna focus on that.
That's a good thing. So originally, the first issuance you did was on your own because you can actually do that in a Reg A plus. It's the exemption doesn't require you to work with a platform provider. Right. And then you decided to work with Aton. So before we talk about how cool Dalmore is,
and they're pretty cool. They're pretty cool, by the way. They're awesome.
So I've heard.
Yeah.
So what did you learn from that experience of doing it on your own?
I'd have to say if I knew then what I know now, I would have already worked with Dalmore. We came to them late in the game because we did start on our own. Now, my business partner is a former securities, lawyer. So I had that benefit. So, we didn't have to rush out and try to figure this out by ourselves. I mean, I had a good partner. He has a lot of people in investment banking and he has other lawyers he's friendly with and auditors. So we were able to put our team together, which would be much more difficult if I didn't have him as a partner. I would have immediately, had to seek out someone like Aton and Dalmore. So we did end up coming around to Dalmore. Originally, it was really to handle these 7 problem states, and we didn't really talk about that. But there's 7 or 8 states that, even though you're qualified nationally by the SEC, there's 7 or 8 states you still have to jump through hoops in, and they require you to either file as an issuer dealer or be working with the broker dealer. So because I was an investment advisor, I was a licensed investment advisor. I had my Series 65 license. We were able to get waivers in some of those states. So again, that's why we did it first. Like I'm licensed. I have a securities lawyer, so we were able to pull it off. But I didn't like the hassle of that, going through, putting my license up and having to, do the waivers and files and issuer dealer in all those states. We did it 3 or 4 times. So we decided to bring Dalmore on originally just to handle those states. And we just said, I'll just do all of them. It's just because it's nice to have a partner who knows what they're doing, who knows how to be compliant, who can handle all the investor information, the KYC, the AML, we ended up just signing on for all the states with Dalmore. Like I said, if I found them earlier, we probably would have done our other offerings through them. And now they have great tools. I mean, we built ours from scratch. We have a proprietary platform built from scratch, have a tech team, have to constantly be upgrading and changing and adding features. And, now Dalmore came out with a fabulous, app, this fractional app. I'm sure you'd be happy to tell you about it, but it provides a lot of the same things our platform does. So again, if that had been available, I would have been, especially since we're a serial issuer, right? We're constantly doing, re-ups of our offerings and our bonds and new securities. I would have jumped on that in a heartbeat. So I do encourage, if there's anyone listening who has a Reg A, to look at that, because you don't want to go through, as you mentioned, my scars, my pain, of having built all these things by myself and sort of navigated it, with me and my team. It's great to have someone who has that experience.
When you call them problem states, I think that's a good label, because some of those problem states are large states, and
they're all large. New
most
York,
people,
New Jersey, Texas, big. Florida, big.
And most people don't know this, that our securities regulatory system is very fragmented, because most people think about the SEC and dealing with them, and it's, everything's the same. But we have 50 states plus, different other regulators that you have to deal with when raising money from the public. And every state is different, and every state has nuances. And so I think that's part of it, is when you work with somebody like a Dalmore who's approved in all 50 states, that streamlines that process. And I think, I'm going to give you some props here, Eitan. You swirl in some of that tech, cocktail tech, you could streamline that even further. So what are let's talk about some of the bells and whistles that you are offering today at Dalmore.
Yeah, I mean, first of all, Sally, thank you so much for your kind words. It goes both ways. It's great to have you. We should have done a better job in finding you and tracking you down earlier, but it's great to see your loyal community still there with you today, and for live, which is really exciting. So from a technology, right? So Dalmore we've been around since 2005. So we have 18 years or so experience in kind of the regulatory and compliance side. We were early on as a broker dealer to get involved in helping companies raise capital online, and that was in the beginning really through Reg D, 506C. But that gave us the ability to build infrastructure, processes, go through audits, get better, learn from mistakes, and grow the team, and really with a focus on being super cost effective, all along. And through that process and over the years, technology has dominated every industry, certainly, crowdfunding. And if you want to be an innovator and you want to take thought into action, you need to have your reins on technology, or rely on someone else. And when you are, and if you're an innovator and you end up having to rely on other people for the life force of taking your thought to action, especially under times of distress or when things have to change, it can be extremely challenging and ultimately risky. So while we love to be Switzerland and work with everyone and be integrated with many platforms, in order to really provide the best solution to our issuers, we really needed to take control over a lot of the different elements of that go into the offering, including transfer agent for single sign-on, et cetera, and things like, and for customizing the shareholder kind of management systems that we have in mind that we're really excited about. For fund administration, we're building a product called Dalmore Fund, which is it has tax reporting, and it has fund administration built in, and TA services for REITs and for hedge funds, et cetera. We have the API version coming out. We have the Fraction app. We saw so many different, of our 300 or so Reg A clients, let's say 75 are fractional share platforms. We saw them all. Okay, how do I put together escrow, payment processing, KYC, custody, AML, digital wallets, ATS, and make it compliant, and give compliance the tools that they need to do their job, and make sure it all works and is better than the competitors? That's a hard task, and it's expensive, hiring a CTO and a dev team.
I can vouch for that. I can vouch for that. Yeah.
So I think this is a big point. I think building your own technology could be more of a liability than an asset. And I think people go into this thinking they're building something unique. It's going to no, good luck trying to run that with the old vendors. And you need to have global visibility on service providers that I think we have to really know which ones to stay away from, which ones work well, and how to reduce friction. You need to always be looking to reduce the number of unnecessary steps while also being compliant. That is best practice, and that is evolving. So the benefits of having a broker dealer like Dalmore that's really in the guts of the technology, that's innovating tools that are helping our clients, I think has become a big advantage. What makes us unique is that we are obsessed with actually being in business for a long time, which means not charging too much for our services so that people who are issuing debt can afford our services, just like people who are selling shares in startups can. And so that is aggravating to other platforms in the industry, perhaps. But our loyalty, again, is really to our issuers. And so we're big believers of keeping costs really transparent, including payment processing. I think that speaks for itself, why we have a lot of the issuers that we have today. So it's superior technology is really the objective here. SaaS growth is different than being a service company. So it was a self-defense move in reality, right? Because we're really good at what we do on the compliance and regulatory side, but we're relying on others that aren't doing an adequate job or providing services that our issuers need. So they have to go and do it themselves? No, we should be able to do that for them. So that's super exciting. The suite of technology products coming from Dalmore Technology.
Okay,
a number of them additional.
You mentioned a bunch of things and you blitzed through them, and you're throwing around acronyms, which I love, but I know a lot of people, they don't think about these things. KYC, AML, know your customer, anti-money laundering. These are required under the law. Dalmore provides that service, correct?
Dalmore provides, KYC, AML are generally done by third-party providers, right? So the issuer would typically someone has to select which vendor that they want to use to perform those. Much of it's automated, right? What the broker-dealer's responsibility isn't to perform per se those specific tasks, but it's to have an adequate provider that compliance is comfortable with perform those, and then to capture, download, store, review, and approve, or deny, and follow up for more information, each investment. So the things that they're looking at are anti-money laundering, checks, OFAC checks, jurisdiction, making sure subscription agreements are signed, right? So Dalmore does the required role of a broker-dealer, but oftentimes there are vendors, third-party vendors that go into our technology.
But from an issuing firm, it's largely just seamless. It's kind of an invisible process.
That's it. Correct.
An investor comes to the forum and say, right, I want to back this company. I want to invest in a worthy bond. And they put their name, address, give you an identification. They say they're not a crook, and and they sign the subscription agreement. That information goes over to you guys, and it's reviewed automatically. If there's a flag, it shows up probably automatically. If it's a deeper flag, maybe somebody else looks at it and says, whoa, this person is an international terrorist. We don't want anything to do with them, or it's a mistake. It's either approved or reviewed. There's a process there. But for me coming on board as an investor, I don't know this is going on because I just want to buy the security. That's all I want to do, right?
Yes.
And going back to the issuer side, so to clarify Dalmore, I mean, you can be a white label provider where nobody really knows that it's Dalmore doing all the heavy lifting, because I'm going to Worthy and I'm buying a Worthy bond, but it's your name, Dalmore, on the offering document. You sign it saying we're the broker dealer of record. If something goes wrong under what we're responsible for, you get in trouble for that. And as we know, FINRA, SEC, and everybody, they take this stuff very seriously. And this is a very important aspect of raising money, not just online, but anywhere. And so that's a key component of what you offer to Worthy and to many other issuers, right?
Yeah, and it can be confusing because when people hear like broker dealer, what comes to mind typically is you hire a broker dealer to raise you capital, and you pay them 7% on a success fee. But there's many different utilizations of a broker dealer, right? That are more administrative, regulatory, and compliance oriented. That a broker dealer plays that with the intention of providing more protection for investors, where there's a regulated, centralized company that is engaged to make sure certain things are done properly, and they're going to be tested on it next audit, right? So that's some of the benefits you get. No one's perfect, and it's not about being perfect, but it's about having more accountability, more sets of eyes on things, really ultimately to try to protect investors as best as possible.
You have to imagine, you have to imagine, Andrew, that state regulators and federal regulators like the fact that an issuer is working with a broker dealer because they're highly regulated. They're, like I said, FINRA, SEC, they're regulated by the same agencies. So I think it gives both an issuer peace of mind, and it gives an investor peace of mind, and it gives a regulator peace of mind that, hey, these parties are compliant, right? I mean, I'm not going to say that, I don't know what's in the mind of the SEC when they're reviewing an offering, but I would have to imagine they feel better about qualifying an offering that you have these these entities involved because they know that it's a compliance issue.
Yeah, absolutely, and that's their job. I mean, that's the SEC largely exists to stem and stop fraud. Same with the state regulators. So Dalmore offers like a cafeteria services and features and bells and whistles, and so people can go to you and they can do everything or some of them, but you're the broker dealer of record and you handle all the heavy lifting of compliance, and you can provide more. So, I don't want to, we're running short of time, and I could talk about this stuff forever. If I was in the elevator with you, Sally, we'd still stay on, up and down. But I want to focus on the importance of working with a qualified professional in regards to working with a broker dealer, but also with legal advice, with auditing and accounting. All this stuff is vital, and you can't just take it casually, because it can throw a wrench in your works if you do, and if you don't get it right. And I will say this, there are a lot of attorneys out there that say they know what they're doing, but they don't. But at the same time, there are a lot of attorneys out there that actually do know what they're doing. And I think it's key that you work with people that have the background, the experience, that understand how to do these exempt offerings before you start, going down that path, because you'd be sorely different, disappointed if you don't. And I don't know, Sally, if you want to add anything to that.
Yes. Now, my advice is don't be flippant about any of that stuff, the legal, the audits, the BD. I mean, how we run our business is literally every email that goes out, every client interaction, every marketing piece, I think to myself, what if the SEC reviewed this? Everything you do, you have to go look through the vision of, if the SEC reviews this email or reviews that customer service interaction or reviews that marketing piece that went out, are they going to be happy? Because they'll see it. They will. I mean, eventually they'll knock on your door. I mean, they do. They came to our place. It's sort of, they show the badge. Hey, show us your record. Show us your marketing. If you're in a regulated financial services industry, they're going to come knocking. And I've seen tons of Reg A's, of course, none that a ton is supporting, that aren't doing things compliantly. Whether it's disclosures they don't have, or whether they're comparing their product to a bank or whatever. There's just things you can't do. Whether they know it or not, and they're, maybe they're not running things by their attorneys. I don't know. But there's a lot of, one thing that I was very surprised at getting in this industry was how gray some of these regulations are. I thought, you follow the rules, It's black and white, and it's all open to interpretation, both by the lawyers, by regulators, by the staff of the SEC. So logic kind of goes out the window, which is hard for me. So because it's so gray, you really need these professionals. I mean, you need people to back you up, to get second opinions, so that's just my biggest message is, don't be flippant. We got to the SEC, now we can do whatever we want. I mean, they will come knocking. So just please operate your business like they are looking over your shoulder every minute, and make sure you do things compliantly. Obviously, working with the BD helps, having lawyers review your marketing, whatever it takes, because, we got held up for a long time over a gray issue with the SEC. Not, it had to do with the kind of loan we were doing, whether it was exempt or not. I mean, it was a handful of our loans out of hundreds that we do. But even when you're doing everything's right. Even when you're doing everything right, like we feel like we were, it can still cause a lot of problems for your business. So yeah, comply.
Yeah, and I'll say that all platforms and providers, anybody's issuing securities, they've had the same experience. They've had FINRA or the SEC call them up, challenge things, question things, ask them to change things. It's everybody, it's the entire industry, because they are the cop in the beat, and they take that very seriously, as they should. And Sally, you're absolutely right that some of these things are open to interpretation, which is frustrating for people. So it's good to work with people that have experience. And I'll say this, Tom, because you work with a lot of serial issuers that go once and go again, that does help in the process, because once you become a recognized entity, recognized broker dealer, or an issuer, things speed up, and so that.
By the way, to that point, we got our first ever no review letter in our last offering. Usually, offerings can take 4 to 9 months, right, to get through because of the comment period and whatnot. And we applied very early for Worthy Property Bonds 2. And within 5 days, we got a letter from the SEC saying, we're choosing not to review your offering. Just go ahead and sell. I mean, follow the rules and go ahead and sell. And our attorney said in 30 years, he's never seen a letter like that. Like, they're rare, but as you become a known issuer, hopefully with luck, you'll start to get some of these letters because it's, they're familiar with you. But yeah, so it can go anywhere from a year to 5 days. So that's one of the frustrating parts. I mean, if I had to suggest an improvement for Reg A, it wouldn't necessarily be lifting, the cap, which some people say it'd be, the transparency and the time period, of the review process with the SEC. Because to me, that's been the most frustrating part, is never knowing if it's going to be 5 days or a year until something gets through.
Yeah. So what I'm hearing from people, and Eitan, you may have a different perspective, is that a lot of people in the space, it's a couple months unless you're a serial issuer, which you're kind of boilerplating things. Then things can go even faster. But since you mentioned this, Sally, so what are some aspects you'd like to see improved? I'm just kind of curious about this. There's a lot of legislation going through Congress now in regards to capital formation, support of entrepreneurs, and access to opportunity. Is there anything about Reg A Plus you'd like to see improved? I hear frequently increasing the exemption to say up to 150 million. Is there anything else out there that you think should be, get some polish?
Is that a question for Eitan?
It's for you first, and then Eitan can jump
for me. Okay, yeah. I mean, we've sold almost $200 million, right, under the Reg A framework. So, it hasn't, the cap hasn't stopped us. We create new entities, with different loans and whatnot. So we've been able to work within the cap. It'd be nice to raise the cap because then you don't have to create additional entities if you're a serial issuer. But like I said, to me, it would be really great if there was a set time frame. Like, all right, within 120 days, they have to make a decision or something, because sometimes they'll go 3 months without answering. It goes into a different department. If you're in CorpFin, which is where you originally submit, they have a process, 30 days and then 2-week turnarounds. But the minute it goes to accounting or goes to the investment company division or other places in the SEC for further review, all those timeframes are off. And so, like I said, and your lawyers will call, they'll just say, oh, it's under review. You get no information. So to me, the biggest change I love is if they could put teeth around some kind of time frame. The whole reason is to support entrepreneurs and give capital to entrepreneurs, but they'll go out of business waiting sometimes for the SEC, review. So like it sort of diminishes the intent of the Jobs Act if they don't respond in a timely manner, so these companies can get access to capital. So my biggest suggestion would be a time frame within which they have to act and give you down.
I like that. Eitan, anything you think that should be improved?
I think Reg A is just perfect as it is. No, I actually no. It's bumping it up. It's easy to say bump it up, right? But it's not like we're seeing so many issuers other than people like who's on this panel with us bumping up against it consistently, right? So let's first see people. What do we do now? So it does happen, but you could always, incorporate like a Reg D for some of the accredited overflow and reserve some of the Reg A, just like people are doing with launching a Reg CF for, and a Reg D together. So there's ways to supplement that. But But to me, it's really just about awareness. I mean, to me, it's the most advantageous security exemption there is right now for those reasons, right? Not that it's fully utilized for what it can become, but this idea of pretty much anyone, pretty much anything, and can sell right away. It's creativity and technology are going to really open up the private markets to a lot more than what you just have to go and market for to join your community. That's what I'm most excited about, is really this transition to institutional capital, and Reg A as a vehicle for issuers. But obviously, yes, raising it to 150 would certainly get my vote.
Okay, so I'm going to jump over to, we're going to take a few questions from the audience right now. I'm going to try to do this very quickly. This is from one person participating. He said, I've only worked with accredited investors. I have heard that some investors are uncomfortable getting into a second larger round when the first round was via a Reg A. Eitan, you want to answer that?
Yeah, I mean, that's like, we heard that years ago. The idea then was, when it was relatively new, was how are institutional or more sophisticated funds or investors going to look at me if I just raise money from widows and orphans? I'm this bad, evil person that opened my eyes. No, I'm serious. But that was the idea, right? It was like, is there a risk in raising money from non-accredited, or what people call even worse, non-sophisticated investors? These are people that are more sophisticated, but again, that was the idea. Today, it's changed big time. Today, it's, oh, really? You were able to go and get thousands of people to believe in you and felt connected to invest in you. You have 10,000 advocates. You have equity value in that decision that was made. You could go back to these people. So to me, it's more a testament to the ability to convince enough people to believe in you and to join the ride. And now we're seeing things like what WeFunder and others are doing with these community rounds. I think it's amazing. It's reserving a portion of your VC round or your private equity round for the little guy, right? For us, for your fans that have been there all along, for your customers, right? And ideally at the same terms and structure as the big guy. That's the real win, right? Not that there's a Reg D with the special, but so that's where, that's my view.
And by the way, if you go,
deal terms count.
But also, if you do an IPO, what better way to do an IPO is if you have 100,000 people in your community that have bought your bonds, your equity. I mean, you have a built-in trading, trading community there as well to, actively trade your product.
Right.
Yeah.
Right. Shareholders and capitalization. You meet listing requirements. You can meet listing requirements through a Reg A, right? So it's an amazing thing.
Yeah, and these people tend to be dedicated. They want to see the company succeed. So you have these ambassadors and these advocates. So here somebody asked about what type of product are you seeing with secondary trading in Reg A? Again, this is going to be for Eitan. And where do the secondary investors come from? The ATS network or the issuers network? Do you have any perspective on that, Eitan?
Yes. Currently the majority of, there's a couple of different secondary related strategies. There's the typical one, which is the very popular private companies that are about to go public and with very high valuations, brand names. And so there's broker dealer networks that have access to, let's say, founders who want to take some chips off the table before the IPO, or, et cetera. So there's that. That's been around for a bit. Where we're seeing the most activity today is amongst the fractional platforms, specifically the ones that are involved in collectibles and art. Naturally, because the way those industries have worked before they were digitized, which is you go out and buy baseball card, Michael Jordan rookie, you keep them in glass, you get it rated, and you get the Beckett, so you get to see what it's worth, right? So there's a trading component built into certain industries or racehorses or things like that, like art, let's say, right? Whereas real estate, there hasn't been as much of a trading relationship to real estate. Majority of our secondary trades right now are with issuers that there are real estate, which is one of our biggest, single family homes, and collectibles and art and cars and things like that. But my opinion is it's going to change dramatically. I think market makers are going to become a big thing this coming year. I think we're going to see that in music royalties, art, and real estate. I think those industries are up for grabs. As soon as you could really create a market-making culture and support around it, I think that's going to give RIAs a lot more comfort in making allocations. And I think that through technology, what we're doing is we're trying to make it easy for RIAs to allocate to some of our issuers, right, in their own format via API, right? So to keep those investors as part of that RIA's assets under management rather than them going to some platform. But today, if you want to invest in many of our issuers, you actually have to go, you download the app, you join, you go through KYC AML, and then you could participate in primary and secondary. So it's not a third-party network that has this big stable of people looking for secondary opportunities. It's not, the market's not big enough. Will that eventually happen? Of course, there's going to be arbitrage opportunities. There's going to be cross-platform arbs. So I think that's going to also evolve. But just the volume is not quite there yet.
Yeah, no. So I agree with you. I think that initially when Reg A Plus came to be, people weren't certain how it was going to evolve. They thought, well, maybe it'd be more mature firms. What I've seen is, first of all, real estate was kind of first out of the gate. It was, there was a lot of interest in the real estate side. I think also you are seeing early stage issuers, startups utilize the exemption as well. And I think what you're doing today, Eitan, with your fractionalization, alternative assets, I think that's just, it's just getting started. And we're going to see more of that. We're going to see trading. It's going to take some time. It's not going to happen overnight, but that's kind of the direction it's going. It's access to alternative assets in a regulated environment that uses technology to streamline the process. Somebody just asked something about blockchain technology and using distributed ledger technology. Are you guys, either of you, considering that? Is that something that's on that you're looking at or doing today and I don't know about? Sally, Eitan, anything about DLT blockchain?
Go ahead, Eitan.
Definitely. Although it's a little bit complicated, right? You have a number of relatively new participants in the industry that have really been pioneers in setting up the infrastructure to prepare for a massive shift to digital, right? Through where you leverage blockchain technology, where you where shares become tokenized and settle more quickly, and therefore reduce costs and make compliance even more accurate and cost effective, and turn these shares into a lot more than just traditional shares. So I think that's wonderful, and I think that is what is going to happen. However, you have to look at the SEC and what their position is on Go and blockchain and Web3, et cetera, and what impact that's happening on for issuers for different exemptions. Remember, Reg A, you need SEC qualification. It's different than a Reg D. A Reg D, you may have blockchain that's built in. You and your securities counsel go through it. You're comfortable. You make the right disclosures. You could launch it. When you submit something to the SEC and it says crypto or blockchain, naturally, you could expect them to ask some questions about that. So you want to work with a securities attorney that has navigated that. Could save you a lot of time and headache with how you model that. So we're building, like, our transfer agent is blockchain enabled. It's not like we're going to push blockchain. It's not like tokenization is something that is relatively easy to do with existing more traditional shares. So we have that in place. Although I think that it's more of a detriment to launch with a model that's heavily dependent or emphasizes blockchain, Web3, tokenization, or crypto, because I think that retail investors are out of favor based on what they've seen in the past. They associate things that maybe they shouldn't, but they associate things like blockchain and tokens with Bitcoin and FTX, and all these things, and Bored Apes, right? So I think what's sexier and what's more interesting today are things like regulation, the SEC, FINRA, because at least I know that these are shares, that these are regulated, that a responsible party has them. In a time when every day I'm reading more the next fraud and the next group of people that lose their money on some blockchain with some token, I'm not sure if that's the right message to be focused on today in some of these exemptions, but I do welcome the benefits that they afford going forward.
I was just going to back. By the way, I was going to back up very quickly just by saying the biggest issue here is the SEC, because they will hold up reviews. They will hold up off rates that use those. I mean, they hold up enough issues already, but you could throw that one in and you'll lose many months, go back and forth with their questioning. So, if you're not in a hurry, you can implement that. But, we thought about tokenizing our bonds for a variety of reasons. But once we started seeing the pushback from the SEC, we're like, okay, that's going to be down the road. Yeah.
Yeah. So
and everything works automated anyway now, because technology has increased. So it's not just like tokenized and blockchain or nothing. It's like there's complete transparency, real-time cap table management, fractionalization, secondary trading. These are all things that work in a relatively automated way. There's so it's pretty strong as it is today.
Very, very quickly, because I've seen some discussion here about the time frame to get a Reg A qualified. In my experience, there are some offerings that take a long time, but if your offering documents are clean, you're working with a provider that is known, has experience, and they do this all the time, that speeds things up quite a bit. And what I'm seeing are those times have come down from when Reg A Plus first launched to 5-6 months, that you're seeing a lot of these things go through within 1 to 3 months. Is that what you're seeing, Eitan? Am I wrong?
No, you're right. It's we are seeing more no reviews for some reason from public companies and from repeat issuers. But we're seeing, I would say on average, the qualification happens like 60 to 70 days from initial submission on average, right? There's the couple relatively straightforward questions on a typical Reg A, provided you have experienced counsel. You get back, and then a couple weeks later, you hopefully get the qualification. So that's a fair assumption, I think, provided you're not doing anything too funky, right? And
I can speak to. I mean, what the process is for people who are curious. The first review is 30 days. You don't hear on day 29. You don't hear on it's day 30. So when you submit your offering, they have 30 days, and let's say it's CorpFin you're submitting to. Corporate finance, it takes 30 days to get your first comment letter. So the length of time it takes to get cleared is going to depend on how many questions come back to some degree in that first comment letter. You can have 25 questions, you can have 15 questions. Some are just easy, like, we don't see a COVID disclosure or whatever. It could be something you just have to add a simple disclosure, or it could be questioning your entire business model, or it could be, questions about, if we want to offer a boost to our interest rate, well, how are you going to communicate that? And what happens when the time period ends? So to Eitan's point, if there's any funkiness, built into your security, changing of a term or something, they'll ask about that. So questions could be anything. So, you'll get that first gauge at your 30th day when you get that letter back to see how complicated or easy the questions are. Then you usually respond within a week or two. Again, depends on your counsel, how quickly they can turn it around. And then the 2-week period starts. So they're supposed to respond to the SEC at that point within 10 business days. So call it 2 weeks. So then you're in that shorter time period. So if it takes 30 to get your first review comment letter, let's say it takes you a week or two to get back, because a lot of times there's a lot of questions that first letter, that's 6 weeks. And then they start responding in 2 weeks, 2 weeks to them, 2 weeks to you. So it just depends. And then basically the questions get whittled down. And then you get a call. I mean, they don't send you a letter saying, okay, you're green light, you're good to go, we approve you. They'll just call your counsel and say, you're cleared of comments. And then you have to send an acceleration letter saying, okay, well, I want to accelerate and sell on Monday, the 15th at 5 o'clock or whatever. So, there's some other things involved there. But I mean, I would always budget like 4 months, particularly if it's your first one. Yeah.
4
because
months.
You just don't know what questions are going to come up. And if the lawyer.
And then everyone's slapping 5 and saying the client, but that's really not a time to celebrate. That's when the real work starts, right?
Exactly.
You feel like you won an award, but that's really okay. Congratulations. Now it's time to really.
But you should also err if you're budgeting, if there's any issuers here or startups. I would err on the long side. Like I had someone who their very first offering was a no review, no experience. They got a no review, and I was really pissed because I was like at month 12 fighting with the SEC at that point. And there's other times when I talked to an entrepreneur, he said it took us 18 months for no reason. Which is way outside. But I mean, I wouldn't ever budget you're going to get ready to go in 3 months. Great if you do, but I would say 4 to 6. Is what you should really think about if you're planning, we're going to have revenue at this point from selling this. So of course, there's a whole marketing campaign and whatnot. But I would always err to the middle to long side, at least for your first offering, because you have no idea what they're going to hit you with on their questions. anyway, that's just my
So I think so. We're way over time right now. So I'm gonna
we're chatterboxes.
close
We're chatterboxes.
close things down right here. I think words of wisdom. Work with people who know what they're doing. The people who have experience. The broker dealer, the attorney, the auditor, everything. Don't go down the road with somebody who says they know what they're doing and they do not. I want to thank Eitan and Sally for participating in this. Awesome that you're sharing your experience. And I want to thank everybody who's joined us today. We will be posting this on Crowdfund Insider. It will be emailed out to everybody, including the people that were unable to attend. And I want to thank everybody who showed up, and have a great rest of the summer. We'll be seeing you in September with an offering to an IPO. I think that's going to be our next topic. It will be a good one. So stay with us, stay tuned, and have a great rest of the day. Thank you very much.
Thanks, everybody.
Take care, guys.